The last thing that I want to jump into is in this same kind of notion of doing this tax planning now and in retirement. Lots of questions, and I think we both get them on TFSAs, especially for incorporated professionals, because it is tax-free money when you withdraw it from the TFSA. And so the argument is that, if you do have some big expenditure, then you've kind of sprinkled out income in other years that you can then tap into when you need it. And in retirement, it can be this tax-free source of income that, if you do want to take that big, like master $25,000 vacation or something that you jumped up your whole life, that you don't screw up your whole tax plan, or maybe it will help you prevent OAS clawback and all that glorious tax planning stuff. So thoughts on TFSAs?
I'm going to say I have a love-hate relationship with TFSAs. So I love TFSAs in the sense that while you have money in them and they're being used properly, they are truly tax-free, they grow tax-free, they can become this lovely vehicle. The hate relationship I have with them is that it's quite challenging to actually fund and contribute the money into the TFSA. If you have windfalls, if you have extra money sitting around, if you have a lottery win, if you have an inheritance, a perfect place to put the money is a tax-free savings account, because you as an individual didn't have to pay extra tax to be able to put the money into the TFSA. So the hate relationship is, and it's nothing against investment advisors because they're doing their job, but a lot of times the goals of the investment advisors don't always line up with, in this case, the tax tail. Now I'm regretting saying that earlier a little bit, but yeah. I'll explain a little bit of why. So let's imagine that we have a client and over the years they've accumulated $50,000 of tax-free savings account room. Let's also assume that they are a higher spender and they have their income at that magical $220,000 limit. So we would know that any extra cash that they would pull out of the corporation would be taxed at 48% on a dividend, 53.5% on salary. With the client coming to us and saying, I want to put $50,000 in my TFSA, the first thing I say to them is, well, that's great, but if you want to take the money out of the corporation, you're going to need to use about $96,000 of corporate cash, extract that out of the corporation investments, pay $46,000 to Canada Revenue Agency, and then you get to put $50,000 in your TFSA. And they go, well, that's a lot of tax. I say, yes, but it's because you're at the top tax rate. And in order to get the money out of this spot, to get it into this spot, you have to pay tax. So then the next thing they say is, well, my investment advisor has said that the TFSA will grow and build and that it is a better investment to put it into there, not have any tax paid on it, and it will be a bigger dollar value than with the money if it was left within the corporation. And my counter to that is, if you have the same investment strategy within your corporation as you have within the TFSA, and let's assume that rate of return was 5%. In your TFSA, year number one, you would accumulate $2,500 of investment income, and you get to keep all $2,500 of the investment income on that $50,000. Seems easy. Within the corporation, that same $96,000 that you wouldn't have had to pay tax on if you didn't withdraw it, you would have $4,800 of investment income. But then we have a tax drag. And let's assume that tax drag is interest income, which ultimately is about 20% as a tax rate. So that 20% tax rate, $960, let's call it 1,000. The corporation gets to keep $3,800. So quick math tells me 96,000 plus 3,800 we get to keep, that's $100,000. And the $3,800 is a bigger number than 2,500. Mm-hmm. Plus, I still have the original $46,000 I didn't have to kick over to CRA. Mm-hmm. So I've done the math, shockingly. But when doing the math, I've compared different types of investment income. I've compared eligible, non-eligible dividends. I've compared capital gains. I've compared interest. I've compared foreign income, all of them in there. And if you have the same expected investment return, the TFSA will never catch the after-tax cash that you could pull out of the corporation at the top tax rate by not paying the tax today. If you took home run type of approaches and you were chasing 20% your TFSA and your corporation was earning 4%, absolutely the TFSA is going to win every single time. But you also have the risk of losing 20% within your TFSA with that type of a strategy. So I usually say, if you have the same investment strategy, the TFSA can't win. But if you have this extra cash sitting aside, if you have an inheritance, you have a windfall, if you have some other way to get the money in a tax advantaged way, put it in your TFSA every single day of the week. Makes complete sense.